Welcome back to Investing Talk Podcast.
Today we're looking at Lumentum.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. Lumentum has, it's just absolutely caught fire. The whole story is fundamentally driven by this surging demand for AI infrastructure.
Right. They're positioned right in the middle of it all, this whole cloud and networking build-out. They're a key catalyst.
They really are. And when we look at their Q1 2026 results from just November 10th, the numbers weren't just a beat.
No, it was more like a systemic validation of that entire AI thesis, wasn't it?
Exactly. Q1 showed an EPS beat. They delivered $1.10 per share when everyone was expecting, what, $1 or 3 cents. But the top line, the revenue, that's the real headline here.
Yeah, the number jumped out, $533.8 million.
Which is an exceptional 58% year-over-year growth. A jump that big just proves they're at the very center of this, this early phase of AI infrastructure expansion.
A 58% jump for a hardware supplier of this scale is, it's staggering. It tells you that the spending from the big players is intense and really it's non-discretionary right now.
And it's the quality of that growth, too. That's the key insight.
It's not growth at any cost.
Not at all. We saw an impressive 1,500 basis point improvement in operating margin. For you listening, a basis point is 1/100%, so that's a full 15 percentage points of margin improvement.
And what does a move like that really signal to you?
It signals leverage. It's the sound of their technical moat translating directly into pricing power. They can charge more because there aren't many alternatives for these specialized components that you need for the AI build-out.
So, strong execution meeting a scarce product.
That's the perfect storm for operational leverage. And the market, well, it definitely agreed. The stock jumped 11.08% in a single day.
Which reflects huge confidence that this is a real structural shift, not just some temporary spike.
Right. And if that Q1 beat was the shockwave, then their forward guidance was the confirmation that the tide is still rising. And fast.
It was certainly aggressive. Management's forecast for Q2 2026 is projecting revenue between $630 and $670 million.
And just for context, the analyst consensus was way lower, only modeling about $561.5 million, so they blew past that.
And that trickles down to the bottom line, I assume.
Oh, absolutely. The projected EPS range of $1.30 to $1.50 is substantially higher than the $1.16 consensus. That kind of guidance tells you management has incredible visibility into their pipeline, better than the market thinks.
So when we talk about that pipeline, we have to talk about their competitive advantage, their moat. It seems to be all in their cloud and networking segment with these specialized optical chips. What makes them so special?
It's not just about being faster, it's the sheer complexity and the capital required. These components are technically very difficult and really capital intensive to make, so the barrier to entry is huge.
You can't just decide to start making these tomorrow.
Not at all. You can think of these chips less like faster wires and more like the high-speed optical nervous system that connects all the AI GPUs inside these massive data centers.
So they're the backbone for the AI brain.
Yeah.
And that technical advantage, it translates into some serious customer lock-in. Lumentum has these long-term partnerships with AWS, Google, and Microsoft, the big three.
Right. And that relationship gives them incredible revenue visibility. The switching costs for those customers are very, very high. They're embedded with the world's most aggressive spenders, which is arguably the safest place to be in the whole supply chain.
Okay, that's all overwhelmingly positive. But we have to zoom out and look at the balance sheet. They're funding this insane growth somehow, and that's where you start to see a few things that need a closer look.
Absolutely. There are two metrics that stand out. First one is leverage. The company's debt-to-equity ratio is at 4.2x.
And for anyone listening, 4.2x debt-to-equity is high. It means they're using a lot of borrowed money to fund this expansion. So the critical question becomes, is this smart opportunistic investment, or is it potentially dangerous over-leveraging?
I think it's the former, but it's still a risk you have to watch. When you have a massive opportunity like the AI build-out, you take on debt to build capacity quickly. The margin improvement we just talked about suggests they're deploying that capital really well.
Then there's the valuation. The trailing PE ratio is pretty high at 166.84. That's pricing in years of future growth.
Precisely. The high trailing PE reflects past lower earnings, but this is where it gets really interesting. Once you plug in that aggressive forward guidance we just covered,
the number changes completely.
Dramatically. The forward PE drops all the way down to 40.52.
So the market's making a huge bet that their next year of earnings will instantly justify a stock price that used to look expensive. That drop from 166 to 40 is the definition of a high-conviction trade.
Yeah. And moving to the technical side, the sentiment is just obviously bullish. The stock has been on a monumental rally this year. We're talking a 52-week appreciation of 499%, and it's trading right near its high of about $274.
A 499% rally is deafening institutional conviction. But when a stock runs that hard, you always have to ask, how much good news is already baked in?
Well, that's where the analyst consensus gets interesting because it feels like they're all playing catch-up. The consensus rating is a buy, but that old average price target of $147 looks completely obsolete now.
It's almost funny watching them all scramble to adjust. It really shows how fast this AI wave hit.
Yeah.
They were modeling a normal chip cycle, and suddenly Lumentum is serving like a wartime spending budget.
Exactly. We've seen a bunch of rapid upgrades. JP Morgan raised their target to $235. Northland went to $250. It's confirmation that the institutional models are finally catching up to the reality of the stock price.
And there was a subtle insider signal too, right?
A small one, but yes. S Squared Technology bought 10,000 shares right after that earnings report on November 10th. It's modest, but it's a good sign.
So let's talk near-term drivers. What should people be watching over the next 3 months?
Okay, the big one, the main event, is the Q2 2026 earnings release. That's expected in early February, after the massive beat and raise we just saw, if they do it again.
That would be the 4th consecutive quarter of beats, and that would likely kick off a whole new rally. The market is just waiting for that next hit of validation.
Right. And beyond earnings, you have what are called flow-based catalysts. ETF rebalancing starts on December 2nd, and then new institutional 13F filings come out around January 9th, if you suddenly see major funds showing up as new holders.
That's a huge tailwind. It validates the story for everyone else.
For sure. And we can't ignore the industry chatter. The whole sector is red hot, so there's tons of M&A speculation. Lumentum could be an acquirer or maybe even a target itself.
And there are rumors too, right, about a new deal.
Persistent rumors, yeah. About a pending design win or a partnership with one of the top 3 cloud providers for their next-generation optical modules. A deal like that would lock in their position for the next 3 to 5 years.
This sounds like an overwhelmingly positive narrative. But as we noted, this kind of high growth always comes with some real structural risks. What are the key drawbacks we need to address?
The primary risk, number one, is customer concentration. Their revenue is so heavily dependent on the capital spending of just 3 companies, they're effectively a hostage to the CapEx plans of the big 3.
And that reliance is a material risk. Tech CapEx cycles can be volatile. If one of those 3 decides to pull back on AI spending, Lumentum would feel it immediately and very sharply.
The supply chain is also a lingering risk. Geopolitical tensions, particularly U.S.-China relations, could impact their supply chains and squeeze those impressive margins we talked about. Management has handled it well so far, but it's always there.
And finally, that valuation risk doesn't just disappear. Even with a forward PE of 40, that's still elevated. If the market rotates away from growth stocks, or if Lumen misses on guidance even slightly, that valuation could compress very fast.
So summarizing the whole investment thesis, Lumentum offers this combination of exceptional fundamental strength, that 58% growth, the margin expansion, and just relentless technical momentum. We'd put an overall bullish rating of about 8.5 out of 10 on it.
That's a very high conviction score. But it seems warranted because you've got this dual opportunity. It's attractive for tactical traders, maybe targeting that $260 to $320 range heading into the February earnings.
And critically, for the long-term investors out there, we're still in the very early innings of this AI infrastructure build-out. This structural exposure could mean multi-year annual returns in the 25 to 40% range, just by riding this massive wave of connectivity that AI will require.
Given that Google and Microsoft are reportedly pushing their suppliers toward vertical integration and often demanding better pricing as they scale orders, the question for you isn't just about growth moderation, but whether Lumentum can sustain that impressive 1,500 basis point margin expansion when the hyperscalers inevitably start demanding better pricing in the coming quarters.